Warren Buffett's rule number 1 is both strikingly simple and deeply profound. Never lose money. At first glance, this principle seems almost obvious, yet its true meaning is often overlooked. Many interpret it as a call for absolute caution, but Buffett's intent goes much deeper. The rule underscores the importance of protecting your capital, recognizing that losses can be far more damaging than missed opportunities. Its bluntness is part of its power, serving as a constant reminder to approach investing with discipline and care. Despite its clarity, the rule is widely misunderstood, often dismissed as unrealistic or overly conservative. In reality, it forms the foundation of Buffett's legendary investment philosophy. The phrase, "never lose money," is often taken at face value, prompting investors to become overly cautious. This literal interpretation can instill a deep sense of fear, making the prospect of any financial loss seem unacceptable. As a result, many individuals shy away from even moderate risks, preferring to keep their capital in low-yield, ultra-safe investments. This avoidance of risk may protect against losses, but it also limits opportunities for growth. Over time, such paralysis can hinder wealth accumulation and prevent investors from adapting to changing market conditions. Ultimately, an excessive focus on never losing money can be just as detrimental as reckless risk-taking. When this rule comes into play, many investors find themselves reacting emotionally rather than rationally. Panic selling is a frequent response during market downturns, as individuals rush to exit their positions in hopes of avoiding further losses. This behavior often leads to selling at a low point, locking in losses that might have been temporary. On the other hand, some investors experience financial paralysis, becoming so fearful of market volatility that they refrain from making any investment decisions at all. This hesitation can result in missed opportunities for growth and recovery. Both reactions are driven by short-term emotions rather than a long-term investment strategy. Warren Buffett is widely recognized as one of the most successful stock market investors in history. However, his famous rule is frequently misunderstood. Many interpret it as a caution against investing in stocks altogether, which is not its intended meaning. In reality, Buffett advocates for thoughtful, disciplined investing, emphasizing the importance of understanding what you own and managing risk. His approach highlights the value of patience and long-term perspective, rather than avoiding stocks entirely. This paradox arises from the nuanced nature of his advice, which encourages investors to be prudent, not fearful. By unpacking this misconception, we gain deeper insight into Buffett's true philosophy on investing. Holding cash may seem like a safe strategy, but Warren Buffett and Charlie Munger have repeatedly emphasized that it can actually guarantee a loss over time. This is primarily due to inflation, which steadily erodes the purchasing power of money. As prices for goods and services rise, the same amount of cash buys less than it did before. Buffett and Munger argue that simply keeping money idle means missing out on potential returns from productive investments. Over the years, the cumulative effect of inflation can significantly diminish the real value of cash holdings. Therefore, understanding this concept is crucial for anyone looking to preserve and grow their wealth. Warren Buffett defines losing money not as the short-term ups and downs of market prices, but as the permanent impairment of capital. This means that a true loss occurs when an investment's value is irreversibly diminished, leaving little chance of recovery. Temporary price fluctuations are common in financial markets and do not necessarily signal a real loss, as prices often rebound over time. By focusing on the long-term preservation and growth of capital, Buffett distinguishes between fleeting market volatility and genuine financial setbacks. Understanding this distinction helps investors avoid emotional reactions to short-term movements and prioritize decisions that safeguard their capital for the future. Price and value are often confused, but they represent distinct concepts in investing. Price refers to the amount you pay for an asset, while value is an assessment of what that asset is truly worth based on its fundamentals. For example, if the stock price of a company falls, it does not automatically mean the business itself has deteriorated. Imagine a well-managed company experiencing a temporary decline in share price due to market volatility, even though its earnings and growth prospects remain solid. In such cases, the drop in price may present an opportunity rather than a loss, as the underlying value of the business is unchanged. Understanding this distinction helps investors avoid emotional reactions to market fluctuations and focus on long-term potential. Investing in businesses with declining intrinsic value poses significant risks that can lead to permanent loss of capital. Unlike temporary market fluctuations, a true permanent loss occurs when a company's core business deteriorates, eroding its ability to generate profits over time. Historical examples, such as the downfall of Kodak and Blockbuster, illustrate how technological disruption and poor strategic decisions can render once thriving companies obsolete. Investors who held on to these stocks saw their investments diminish irreversibly as the businesses failed to adapt. This highlights the importance of thoroughly assessing a company's long-term prospects and not relying solely on past performance. Understanding the underlying factors that drive intrinsic value is crucial to avoiding investments that may never recover. When it comes to successful investing, focusing on your process rather than the price is essential. Prices can fluctuate due to market sentiment, short-term events, or external factors beyond your control. However, by maintaining a disciplined investment process, such as thorough research, clear criteria for buying and selling, and consistent risk management, you can make informed decisions that protect your capital. This approach aligns with rule number 1 and never lose money. By prioritizing process over price, you reduce the risk of making impulsive choices that could lead to permanent capital impairment. Ultimately, a well-defined process helps you navigate market volatility and safeguard your investments for the long term. Buffett's circle of competence is a guiding principle that emphasizes the value of investing only in businesses you thoroughly understand. By focusing on areas where your knowledge is strongest, you can make more informed decisions and avoid unnecessary risks. This approach helps investors steer clear of unfamiliar industries or complex products that might lead to costly mistakes. Understanding a company's operations, market, and competitive landscape is essential before committing any capital. Ultimately, staying within your circle of competence allows for greater confidence and consistency in investment choices, leading to more sustainable long-term results. The margin of safety principle is a foundational concept in value investing. It involves purchasing assets at prices significantly below their intrinsic value, creating a protective buffer for investors. This cushion helps guard against errors in judgment, unforeseen market downturns, or inaccuracies in valuation. By buying with a margin of safety, investors reduce the risk of permanent capital loss, even if some assumptions prove incorrect. The principle encourages discipline and patience, emphasizing the importance of waiting for favorable opportunities rather than chasing market trends. Ultimately, the margin of safety serves as a safeguard, allowing investors to navigate uncertainty with greater confidence. Rule number 1 serves as a crucial pre-investment filter for anyone considering where to allocate their capital. By emphasizing the importance of not overpaying for an asset, it encourages investors to carefully assess the true value of a business before making a commitment. This rule also advises against investing in companies that are not well understood, helping to minimize unnecessary risks. By following these guidelines, investors can avoid common pitfalls such as emotional decision-making and speculation. Ultimately, rule number 1 acts as a safeguard, ensuring that investments are both rational and informed. In today's fast-paced investment landscape, many retail investors fall into the modern trap of misinterpreting rule number 1, never lose money. This misunderstanding often leads to the break-even fallacy, where individuals hold on to losing positions, hoping to recover their initial investment. Such behavior is driven by loss aversion, a psychological bias that makes the pain of losses feel more intense than the pleasure of gains. Instead of cutting their losses, investors may double down or wait too long, risking further declines in portfolio value. Over time, these decisions can erode capital and undermine long-term financial goals. Recognizing and overcoming these biases is crucial for maintaining a disciplined investment strategy and protecting one's portfolio from unnecessary harm. Undisciplined investors often react impulsively to market fluctuations, chasing trends or making decisions based on emotion rather than strategy. This approach can lead to unnecessary losses and missed opportunities for growth. In contrast, investors who adhere to rule number 1 maintain a disciplined process for redeploying their capital. They carefully evaluate each investment, ensuring that their money is consistently working in the most productive way possible. By sticking to a proven set of guidelines, these disciplined investors are better equipped to protect and grow their wealth, even during periods of uncertainty. Their methodical approach helps them avoid costly mistakes and capitalize on long-term opportunities. To genuinely follow rule number 1, a disciplined approach is essential. Begin with careful preparation, ensuring you have a solid foundation before making any decisions. Honest self-assessment allows you to recognize your strengths and weaknesses, helping you avoid costly mistakes. Thorough research is the next step, equipping you with the knowledge needed to make informed choices. Finally, patience is key. Waiting for the right opportunities rather than rushing in increases your chances of success. By combining these elements, you create a prudent path that maximizes your potential while minimizing risk. The process begins by clearly redefining your investment goals, ensuring that your objectives are both realistic and aligned with your long-term vision. Next, it's important to build your circle of competence, focusing on industries and businesses you truly understand. When evaluating potential investments, value businesses conservatively to avoid overestimating their prospects. Always demand a margin of safety, which acts as a buffer against unforeseen risks and market volatility. Finally, patience is key. Wait for the right moment before making a decision, rather than rushing into opportunities. By following these steps, you can create a disciplined and thoughtful approach to investing. By following a disciplined investment process, individuals can navigate the complexities of the financial markets with greater confidence. This approach emphasizes consistency and adherence to a well-defined strategy, which helps to minimize emotional reactions to market fluctuations. As a result, investors are less likely to make impulsive decisions based on short-term market noise or volatility. The process fosters a sense of safety, as each step is guided by clear principles and risk management techniques. Over time, this leads to peace of mind, knowing that investments are aligned with long-term goals. Ultimately, a disciplined process makes investing more straightforward and less stressful, regardless of external market conditions. The principle of never lose money extends beyond a simple rule. It becomes a professional mandate for investors. This approach requires constant homework, rigorous valuation, and unwavering discipline. By committing to thorough research and careful analysis, investors shield themselves from the pitfalls of ignorance and impulsive decisions driven by emotion. Discipline ensures that choices are guided by facts rather than fleeting market trends or fear. In this way, the mandate serves as a safeguard, helping investors maintain focus on long-term value and avoid costly mistakes. Ultimately, Reframing this principle emphasizes the importance of preparation and self-control in achieving lasting financial success. As we wrap up, remember that investing is a personal journey shaped by your own experiences and insights. We invite you to share your unique investing rules in the comments, as your perspective could inspire others. If there are topics you'd like us to explore in future videos, let us know. We value your input. For more guidance and thoughtful strategies on building long-term wealth, consider subscribing. Together, we can continue learning and growing as investors.